Business funding, PG versus no PG, personal guarantee versus no personal guarantee. One of the most exciting but mystified portions of business lending that we're going to break down in this live stream. So we're going to be covering what the difference between PG or personal guarantee and no PG, no personal guarantee is. We're going to get down into the weeds of this, not only what it means for you as the borrower, but what it means for the bank as the lender. Get into the weeds about, what the thresholds and criteria may be. And we're going to also cover some lenders that provide no PG. We're going to talk about how to get to no PG at your financial institutions, the mainstream brick and mortar ones, because they're a bit more difficult. And I'm going to give you some alternative funding options to help get you to the stage of no PG. And I'm going to break that down as we get through this in the live stream. But there's layers to this. One of the biggest challenges I've noticed with personal guarantee funding and no personal guarantee funding, when that conversation is had, when that training or that information is put out, it's a little convoluted on how easy it may be to access and what the pathway to accessing it may be. So the goal of this live stream is to help you be more successful when applying for business lending and business funding. It is very important. As you can see in the thumbnail, and as I've talked about in many other videos, the ratio for approval for business lending is not very appealing. It's not very high. Most of us are running into denials, or we're running into poor limits or poor lending options for business funding. And if you are a viewer of this channel, or if you're new to the channel, you're about to find out business ownership and business investing is literally one of the cornerstones, time-tested, proven ways to build wealth in this country. And I specialize in providing the content that helps you get there from the ground up, meaning how to go from all the way from your basic personal banking all the way up to business funding and scaling yourself into a position where you can make that one of your pathways to financial independence. So we're diving into the personal guarantee versus no personal guarantee because I want to give clarity and I want to give some direction that may not be there from other content creators or sources you've been dealing with, because a lot of other people are selling a lot of programs and products that are related. So if you're coming into the live stream live, make sure that you leave a thumbs up, leave some support, leave a comment down below. Let me know you're in the building. Credit Cousin, what's up, my guy? I appreciate having you in the building on this lovely Sunday evening. Make sure y'all leave y'all thumbs up, leave y'all support. We're going to be covering some good content in this one, as always, with the intent of giving you actionable information that you can literally take immediately and go apply into advancing your personal and your business finances. So getting into the weeds, what is the difference between PG and no PG, or personal guarantee versus no personal guarantee funding? So in a nutshell, basically personal guaranteeing is what it sounds like. When you go to apply for business lending, PG or personal guarantee means that you are yourself backing as a form of recourse if for whatever reasons the money being borrowed cannot be repaid. So again, that's basically saying I'm going for a loan that's going to be in my business's name and under my business's EIN number, but I am taking personal recourse if for whatever reasons those funds cannot be paid back. That is personal guaranteeing. If you are no PG or no personal guarantee, that basically is going to be the opposite. You're taking on funding from a lender fully in the business's name and under the business's EIN number, but you yourself are not backing up as recourse if for whatever reasons those funds cannot be paid back. Your personal assets, your personal credit, in most cases is either drastically limited or completely separated from the default process if that were to take place. So no PG funding has a lot of steam behind it, obviously. The idea of being able to get your hands on some really good capital from a financial institution or from a lender and not having to worry about if for whatever reasons things went awry, being personally liable means that you can move on with your life, maybe take another attempt at business or take another pathway without carrying the burden of your credit being completely crushed and potentially sued for your personal assets. So for that reason, very legitimate business owners take appeal to this option. The challenge comes in on this is many many individuals and entities that cover the content and the information around this don't do a good job, whether intentionally or unintentionally, of describing the pathway of getting there to no PG. It is not an entry-level lending option. It's not. That format is not something that you walk in the door with your lender, your bank, or even some of these fintechs popping up, and it's just like you walk in with your brand new business and you just decide you're not going to put your name on it. It's not that simple. So what we need to get into is, what does this look like in the lender's eyes really quickly? What this looks like in the lender's eyes is risk and liability. When you PG behind business funding, business lending options, that gives the lender an expanded scope on the ability to recoup the money that they're putting out. It limits their risk. Not only is your entity going to be liable, and they're going to be able to do underwriting on the entity and find out the entity's ability to pay the money back, they also personally have you as a form of recourse. So that basically means if the business entity dries up and evaporates overnight, we still can lean on you personally as the individual. And, you likely may have some kind of assets. You may still have a W-2 job or some form of income. You may have some kind of stock portfolio or other real estate you own. So this basically means the lender is now in a position where it's like, okay, we're at least mitigating this out and spreading out our risk from the business to the business owner as well. So when you have no PG, this is what a lender is in a scenario where literally now they're resting on the success of this business and the business's continued ability to repay on the loan. So it's broader, it's a deeper risk for them because they have a more limited scope or capacity to recoup their money. They no longer have you or any other owners that could be on the business as additional recourse. So that in itself should let you know immediately now that this isn't going to be an intro level game. This is not for beginners, because a business, any financial institution or lender is not going to be crazy enough to take the risk of betting on you with no track record whatsoever and not even able to pursue you if you're unable to pay, if your grand idea doesn't work or the business that you're operating doesn't work. So qualification requirements, personal guarantee. A personal guarantee can help a business or businesses, especially startups or those with limited credit history, qualify for loans. Lenders may be more willing to lend with a personal guarantee in place because it reduces their risk. No PG typically requires businesses to have a strong credit history, consistent revenues, a solid financial track record to qualify. Qualifying can be more challenging, especially for new businesses, obviously. So let's talk about the long terms. Let's talk about, okay, we know long terms are based off risk. They're based off risk and use case, but risk in this particular conversation. What I mean by that is when the lender's going to want their money back and how much they're going to charge you for the money, aka interest. So long terms, when you look at personal guarantees, you're going to have more attractive long terms. Why is that? Again, it's because there's less risk for the lender. Mitigated doesn't mean there's no risk, obviously, but there's less risk. And when there's less risk, the lender is willing to give more favorable terms because they're a bit more comfortable they're going to get their money back. So you may have longer durations. You have to pay the money back, which is always a plus. You may have lower term or lower rates, rather, on the money that you're borrowing. When you're no PG, this may come with higher rates to compensate for the increased risk that lenders are taking. And you may possibly have shorter terms. So there's unlimited and limited PGs. So that basically means that you can have complete separation and anonymity from the default process if something were to go wrong or go awry, or you can have a limited capacity, meaning that, there's some agreed upon threshold that you may be exposed. So very important when you're dealing with your lenders and you're looking at applying for business lending, you need to understand at what capacity you are providing recourse. And so you need to make sure when you're dealing with your lender, however you submit your applications or doing your due diligence, am I fully personally guaranteeing on this product, et cetera. Now, most lenders do a good job of disclosing this because there's a lot of regulations around this. So they have to disclose pulling your credit in the first place. They have to usually let you know these things, but you just want to make sure that you get context on this because obviously it makes a difference if things just go all the way left for some reason. So SBA, a lot of you I know are big fans of SBA loans, or at least find them to be very attractive or something to be sought after when it comes to business funding. SBA is very popular for business funding, but I tend to clarify that, SBA is a very difficult form of funding. And to be clear, SBA is not the lender. They're the government backing behind lenders, but it's a loan type basically, right? So this is a line of credit or a term loan, or real estate, whatever the case may be, that's backed by the SBA. So we've just broke it down and said SBA lending or SBA financing options. SBA is almost always going to require a personal guarantee for anybody with 20% or more ownership into the business entity. Again, SBA is going to be the most attractive form of lending in vast majority of cases for business lending, thus meaning that they're going to be the most stringent. So that basically means the more attractive the financing terms are, usually the most documentations and criteria is required. There's more of a threshold there because SBA is providing lenders with the security of knowing that they are going to be made whole or really close to whole if something goes bad in that deal where they're not able to get paid back from the borrower. But you got to remember, SBA is going to be pretty much tax dollars, by the way. So the government has to be mindful, a reasonable steward of that money. It can't just go around backing in any and everything with a pulse that applies for a business loan. So it's going to be one of the more stringent forms of underwriting you could ever encounter for business lending is going to be SBA. And they are very strict about personal guarantees for the most part. You got to be really up in the food chain to get a no PG SBA loan. And I mean, revenues and track record has to be really up there. So what are the revenue bases when it comes to no PG? What are going to be the basic revenue requirements you're going to most commonly run across when you're applying for no PG funding? So it really depends on the lender and the financing, scenario. Needless to say, there's no uniform, as always in this space. There's no uniformity in that capacity. Some lenders may require annual revenue thresholds around 100 to 120,000. You may find some down to $50,000 in that scenario, meaning that you may find some lenders, most likely going to be like fintechs or really small institutions, that may do $50,000 in annual revenues and potentially allow you to no PG. So lines of credit, you're going to be looking at, you might find some $50,000 and $100,000 line of credit options if you really dig around. But for the most part, you're going to be looking at north of 150, 200,000, 250,000 in revenue to get in that no PG conversation. And the more established that lender and institution is, the more likely it's going to be higher in that revenue range. Business credit cards, actually, funny enough, could be even higher. You could be looking at 6 or 7 figures in revenue before they'll allow you to no PG on corporate cards, basically, for business funding. So if you look at a Chase Bank, an American Express, some of these larger financial institutions, you'll find separate sections that go over corporate card options. That's basically going to be that threshold where they're dealing with the entity in itself and not just the small business owner. That's your no PG threshold. And if you look at Amex in particular, they're one of those scenarios where you're looking at steep 6 to 7 figures before you get into that conversation with them. So very, very important to understand that when you're dealing with no PG, you're going to be dealing with a lot of fintech companies. You're going to be dealing with a lot of alternative lenders. Your standard traditional brick and mortar FDIC insured institutions are not going to commonly go the no PG route easily, meaning they're going to be looking for really decent revenues, extended track records on those revenues. So not you just had one good year last year, you did 250. They're going to be looking for 2, 3, 4, 5+ years of consistent revenues for that entity. So very important for you to understand. And this is where it gets convoluted for, the other content creators and some of the other sources of this information. They will lead you to believe that you can just stack up a handful of trade lines and, on a certain sequential order and get it reported to Dun & Bradstreet, et cetera, and just walk into a Chase Bank or or log in online on American Express, and you're just going to get this high limit, no PG credit card. I assure you that will not be the case. Let me save you a little bit of time. That is not going to be the case with those types of institutions. You're looking at a very serious track record, a lot more documentation. They're going to be looking for an entity that can stand up on its own 2 feet. And so you being a small business owner, solo operating, or maybe just a couple owners on there, and you're doing 100,000, couple 100,000 in revenue, which is nothing bad. It's something to be proud of if you are fitting that criteria. But you most likely don't have a business at that stage that can self-sustain on its own if you weren't around. That's one of the ways or the criteria or thresholds or lenses you can look at this through for the eyes of a lender is no PG means that you generally have an operation, especially again for these more upper echelon brick and mortar institutions. You're looking at an entity that is largely able to function without you and continue to generate revenue and continue to build, grow, and repay, even if you aren't around in the picture for some strange reason. If you have any credit questions, post them now. Today is my birthday. I'm feeling blessed. You can get blessed today by JP and myself. Yeah, my guy, credit cousin. Happy birthday to you, my boy. Yes, sir. But just to let y'all know, one of my guys watching, he does have his own YouTube channel and is also respectable in the credit, banking, finance space, etc. If you guys are on a live stream right now have some additional credit questions around personal credit, personal banking relationship, business lending, business questions, I got a credit cousins in the comment section that's going to back me up in answering some of those questions. So just to let y'all know. So as you can see, when it comes to no PG, not a walk in the park to qualify for it. But what I want to do is lay you out a framework of some of the options that are out there. And I also want to lay you out a framework on how you can work your way to no PG, even with higher level brick and mortar institutions. Now, this is going to be a generalized framework because I don't know your specific business, your specific financials. As always, all I can do is try to paint you a picture with the data and the facts and from experience. For those of you who may not be familiar by chance catching this live stream or the replay, I am a retail banker and a business banker by trade. I work for a mainstream financial institution. So the content information you get on this channel is coming from firsthand, me literally working with individuals around the things that I'm covering on a daily basis and have been for over 10, 11, 12 plus years at the time of this recording. So I do want you to understand you're not just getting this from, a John Doe on the internet who took a course or joined somebody's training program 6 months, a year and a half ago, and all of a sudden now I'm an expert on the topic. I'm giving you this as an actual expert who does this for a living. I help small businesses with business lending requests all the time. So just to put context on this, I am going to give you some pathways, some framework to get yourself in a position where you can fund a significant real estate portfolio or a franchise opportunity or, a standard, your own brick and mortar, organic, custom business, whatever the case may be, to get you to a point where you can use your PG, because you will have to use PG for a while. Most of you will not be in a situation where you can skip past that, but we're going to talk about that in a minute. So when you start looking at, the criteria for no PG funding, there still could be some assessment around your personal finances in the process. So both personal and business credit scores may play a significant role. A stronger credit profile can improve your chances. Time in business is going to be huge. A year is almost always the ground floor, with minor exceptions to around 6 months. A year is going to be the most common. You need to have been in business with a financial track record. Not like I started an LLC a year ago and I have no track record, but I'm going to bring that LLC into a banker institution with no documentation, no revenues, nothing behind it. A year in business with financials. Business structure. There are some of you out there who this is important for. I haven't shot a video around this in a while, but when I did, it was a really important video that got some good, traction. A lot of you are not understanding how important it is to be a fully legitimized business structure. Sole proprietorships are not attractive to banks and lenders. They are not appealing. It literally puts no separation between you and a business entity. And that means that there's going to be significant limitations in the growth and scale of that operation in the eyes of the bank or lender. it also means that there's a significant risk to the lender to lend out to you at any scale or level. A lot of times they just won't if you're a sole proprietorship. After business credit cards, a lot of financial institutions won't even deal with you on like lines of credit and term loans and stuff like that. They really won't even deal with you as a sole proprietorship. It's too risky. It's not enough room for growth and scale. It's just not usually worth it. So LLCs and corporations are going to be very important if you're looking to go no PG. So strong financial track record and cash flow. Cash flow will be crucial if you are looking to go no PG, especially if you're going no PG because you have bad credit. Your business entity will hopefully have some established credit, which we'll talk about what that looks like to establish if you don't already know. But if it doesn't, the next thing you will find, and we will go over a few of these, is fintech and alternative lending companies that will provide you with no PG funding options. They will be leaning extremely heavily on your banking relationships and your revenues, your cash flow. They're going to be very, very big on making sure that you have reasonable banking relationships, managing well, you're not overdrawing the account, you have consistent inflows, and you have something left over after expenses. Collateral is another big option. On top of cash flow and potentially aside from cash flow, you can get yourself a potential set of no PG options by having collateral. So this is another way for you to spread out the risk for a lender, especially if you're looking for that lender to rely solely on your business's capacity to repay. So cash flow and collateral. If you watch my channel, you already know I throw it out there for you. I'm not the one who originated it, but I am somebody that works with it on a regular basis, and I perpetuate it. Credit, cash flow, collateral. That is going to be your foundation, your trifecta to getting any type of lending or funding available, period, in the marketplace. I don't care how alternative it is. They will require one of the three on some level. You're either going to have money coming in, you're going to have something of value that they're willing to lean on in collateral, or you're going to have a very good financial track record of repaying people. Some combination of the three is ideal, where you have two or more of the three. But one of those three is going to be absolutely crucial for you to get some kind of capital. I assure you. PNR Connected, my God, good to have you in the building this evening. I got all my soldiers in with me today, all my pioneers. So that's going to be going over that. Let's take a look at just skim over a few of our top no PG lenders you might find out here. So merchant cash advance options are going to be some of the most common no PG options you have, where they're going to either not require credit or they may pull it, but they're not going to force you to personally guarantee. So merchant cash advance is going to be where you are providing basically revenues coming in, and they're going to be drafting based on those revenues. So your cash flow is what they're leaning against, and they're going to, bill you at some rate. They're going to basically give you your future cash flow in advance. That's probably the best way to surmise it. So basically, if you got $5,000 a month coming in, and you're looking for some funding, depending on if you meet the metrics and the criteria, they may lend you 25, they may lend you, call it 3, 6, 9 months of funding up front. So 25, 35, 50 grand, whatever the case may be. And then they'll set up recurring drafts. And sometimes it's as frequent as multiple times a week. Sometimes they draft in daily, depending on the lender you're dealing with. It gets aggressive. Now, I'm going to be honest with you. Merchant cash advance is extremely convenient. It's a lower threshold once you do have revenues. They tend to be much lighter on credit and other bases. You will need to have a stable banking relationship. 6 months to 1 year in business will be a minimum, but is it usually expensive? Merchant cash advance is usually expensive. It is not a cheap option. It is a good short-term funding option. If you're having cash flow issues, could be a good option. If you have a really good opportunity for growth or expansion, then you can use merchant cash advance as a good option to get some short, quick capital with a low threshold, but it's going to cost you. So Credibly is one. Credibly offers merchant cash advance from $5,000 to $600,000 with terms from 3 months to 24 months and factor rates as low as 1.11. Flora Financial provides merchant cash advance and term loans with a A+ rating with the Better Business Bureau, considering overall business health rather than just credit scores. So they're looking at a comprehensive look at your business financials. Rapid Finance offers MCAs, merchant cash advance from $5,000 to $500,000 with flexible payment options and faster access to working capital. Lendio is a popular one you may have heard of. Functions as a marketplace connecting business with various lenders, some of whom offer MCAs with no personal guarantee. So they're kind of like a broker, an online broker, or a lending marketplace. Giggle Finance. It's another MCA with low credit score requirements. Equipment financing. This is another decent one. Kind of expensive, but if you got the kind of business that has tangible equipment that's of value, this is another way you can go no PG and get decent amounts of money. Triton Capital provides equipment financing without requiring a personal guarantee, as equipment itself serves as collateral. National Funding offers equipment financing as a way for businesses to acquire machinery or technology with potentially better interest rates and flexible payment options compared to traditional loans. On Deck, another popular one you probably heard of, offers equipment loans, leases, potentially securing the loan with the equipment itself, eliminating the need for a personal guarantee. Invoice Factoring. This is another popular one that is available. Yeah, they are very expensive, credit cousin. They get real pricey. Definitely only a short-term option for sure. Invoice Factoring. This is going to be if you have the type of business where you're invoicing your clients, meaning that you're doing the work and then invoicing, billing on the back end, and you have that money coming in after the fact. Invoicing can be a scenario where you're doing the work and you might not get paid for a week, multiple weeks, a month, 60 days out. So if you have that kind of business operation and you're doing invoicing, it is a popular lending option, meaning that it is a good form of collateral. You have a consistent path of provable invoices, meaning that you have, a track record that your books, you can just demonstrate that you have thousands, tens of thousands, or hundreds of thousands of dollars in invoices on the way in, and that's the perpetual your business runs. You can absolutely get access to some capital leaning against those invoices because the lender will use those invoices as collateral. Resolve specializes in invoice factoring, enabling businesses to receive upfront cash by selling their unpaid invoices, selling them. So basically that means that they're going to lean against that easier as collateral. In this case, that means when those invoices come in, some portion of it is going to go to that company when it comes in. So again, they're kind of doing the MCA concept where they're just going to give you the money up front and they're going to lean in on your invoices to get the money back in. Commerce Commercial Credit offers invoice factoring with a simple online application using invoices as collateral instead of requiring a personal guarantee. Factoring Express emphasizes customer creditworthiness over business credit when offering invoice factoring, making it a viable option for businesses with poor credit. So that's another option. All right, so here's a couple options some of you may not be aware of. Action Opportunity Fund. So ACCION, I may not be pronouncing that correctly. That's why I spelled it out for you. A CDFI that may offer business loans without a personal guarantee, especially to businesses in historically underserved communities. Take notes. ACCION Opportunity Fund. It's a CDFI, Community Development Financial Institution. I've talked about them at length in different live streams. I work at a mainstream financial institution that funds CDFI. So I've worked with these companies or institutions one-to-one. I literally have referred clients back and forth and everything. I work with them closely. They're very, very, very helpful in the marketplace. If you're a business owner, aspiring business owner, and you're looking for funding options that are going to be catering to those of you just getting started or those of you who don't have the best financials and you're trying to get your business off the ground or get it supported, CDFIs are a great way to go. This is one that made the mainstream, search, which is ACCION Opportunity Fund. So they're a good one for you to look at. US Bank offers an unsecured quick loan with the same day funding and no requirement for a personal guarantee. But minimum credit score or revenues are not available online, meaning that they're not advertising it. So there's no telling what the criteria may be. But US Bank is a mainstream financial institution that may be an option. What are some fintech options that are doing the no PG route? Fundbox, known for advancing and outstanding invoices. On Deck, we just talked about them. Bluevine provides business lines of credit up to $250 with some lending partners not requiring a personal guarantee. Fundera, a loan marketplace where options for no PG loans, including business lines up to $750,000. Fund Through specializes in invoice factoring with no PG, financing up to 100% of the value of your invoices. So if you have that, that's nice. National Business Capital. That was another one that was business financing products, including options for no PG. Triton, we talked about. Credibly, we talked about. Kiva is still out there. KIVA offers peer-to-peer microloans at 0% APR, no fees without requiring a credit check. PayPal offers working capital loans. Square, if you're using their platform to bring on revenue, Square can be a good option. They will go strictly off of the sales that you have going through their platform. I already talked about Axion or Axion Opportunity Fund that popped back up for us. All right, so let's talk about let's wrap this live stream up talking about how to structure yourself financially to scale up to no PG. I'm going to be honest with you as I get into this portion. This isn't something that I am as hot on because of the fact that no PG funding is more costly, generally speaking, than personal guarantee. And so honestly, a lot of my content is geared towards personal guarantee funding. It is leveraging your personal finances, your personal banking relationships, your personal credit, and using that as a force, as a power source to get quality, high scale, high limit business funding earlier on. No PG is going to be a slower and more expensive route, generally speaking. It will get to you as something you can do in 3 to 6 months by stacking these trade lines, etc. And it's true to an extent. But what you don't understand is a lot of the content in that arena is around trade funding, meaning that you can use the Grangers, the Quills, the Ulines, start there and work your way all the way up to the ladder, like, to fuel cards, fleet funding, etc., like stacking these various trade credits, straight trade credits. So think about, I run a cleaning business and I decide to go to Uline for cleaning supplies, and they give me, instead of me paying for it up front, they allow me to finance it for 30 to 60 days, net 30, net 60. All right. That's going to be your foundational basis of starting to build some kind of credibility, because they will allow you to finance whatever your, purchase may be. And then they'll report that on your DUNS number typically, and potentially on some of your other business credit on your EIN. You can do that at scale, right? You can start to scale up with these various, these various businesses that are offering equipment, tools, and resources that your business may need. So they're typically business to business entities that allow you to finance out equipment and materials, okay? For lack of a better term. You can stack that up and work your way up into eventually cash financing. That road is something that takes you, stacking up a dozen plus 15 of those trade lines of different varieties. You can't just have 15 U lines on your business credit report and then walk into Wells Fargo, Chase Bank, Bank of America, and get no PG funding. But if you watch the wrong content, you'll get under that premise that you can do that, and it doesn't work that way. So to put this together, what I'm saying is you can build business credit by stacking various forms of trade credit, fuel credit, fleet funding, all these different things. Best Buy, different forms of funding as you work your way up. Home Depot, Lowe's, those things can go by no PG and can lean on your personal DUNS number or your EIN number and start to build you up. Dun & Bradstreet and your DUNS number is almost strictly going to be around trade funding. You're not really going to get any cash level financing options or credibility with your DUNS number. That's another huge misconception. I probably should have stuck this way earlier in the live stream, but your DUNS number is going to be for predominantly trade credit. So that's out of the way, out of the gate. You're not gonna, your paydex score, your DUNS number is not gonna typically lead you to cash funding. Your EIN, meaning your Experian, your Equifax business, those type your EIN reporting to that end of your business credit spectrum. That is where you're gonna start to build credibility that can lead to cash funding, lines of credit, business credit cards, term loans, etc. Your Dun & Bradstreet, Sam's Club is another one, correct. Sam's Club is another good example. Shout out to you, Credit Cousin, for that. That was drawing a blank on some more options. But yes, Best Buys, Sam's Club, Office Depot, these are some of the places you can go and get financing with them directly or business credit cards with them directly and go no PG with them. You're usually going to need to establish a few trade lines on your business credit report to get to that level of the Sam's Clubs, Lowe's, Office Depot, some of the ones I've named. You're going to need to stack up some trade lines. Now, as I was alluding to, I am somebody who's an advocate for personal guarantees. For one, yes, you want to be mindful that things can go bad. If you can protect yourself, you want to do that, okay? But generally speaking, you don't go into business to fail. And you definitely don't want to start taking out debt and don't have some kind of solid foundation on how you're going to sustain or pay that debt back. This is why I'm a big proponent of your personal finances, and I'm a big proponent of keeping your W-2 job or your stable source of income as you get into real estate funding or business funding. Because if for whatever reasons what you're doing with your business, where you might be trying to scale up, start a business, buy a franchise, whatever the case may be, you want to have the kind of personal financial situation where if things are taking longer to bubble or things aren't bubbling at all, that you can sustain the business funding that you took out for a long duration of time. It will be uncomfortable for you to do, be a lot of pressure, but you want to have good personal financial circumstances, which is good stable income and what also good high personal credit limits. Because what ends up happening is if you have to be a good steward with money, you have to know how to move money around. But if you have good personal credit, great high credit limits, you have good relationships with banks on that side and good stable income, you can almost always get your hands on more credit personally. And that can help you float, rotate, and move things around if you borrow money on the business side and things aren't moving for you at that time. Because it's going to happen. For many of us, it's going to happen. We're going to borrow money. We're going to have a business idea or business opportunity that's either not going to work out very well, going to take longer to work out than expected, or it's going to trickle in. And so, not many of us hit it big early on is the name of the game, all right? So I do want you to have a plan in place, and I am advocating for you to have strong personal credit relationships with banks, high credit limits. This is why I talk about it. At one point in time, I was doing straight content on, banking relationships and building out strong personal credit limits. And I'm going to get back to that, going in the future in dabbling in that, because it is very important to have that background in support of you going in for business lending. You're taking on a lot of risk. Let's be clear. I am an advocate for you using debt and leverage to scale out and grow your finances. But maybe I don't say enough. It is risky business. It is very risky business. So before I get into the rest of the strategy, it is important for you to have a good stable income source and good personal finances when it comes to credit cards, high credit limit, and good relationships on the banking side personally that will allow you the capacity to borrow personally to compensate on the business side if you have to. if you have to keep yourself afloat. So all right, Credit Cousin, I see you, my guy. See, word on the street, AAP is looking to do 4-to stock split. He's just giving some good general investment advice down at the bottom. So, all right, listen. Good personal income, good personal credit, good personal banking relationships to be prepared to carry the load or the repayment need or debt servicing on the business side. So what you really want to have is enough personal assets, income, credit to branch into business lending. So what that looks like is when I'm starting my business, if I don't have anything going for the business yet, which in a lot of our cases we don't, there are some scenarios I see clients myself that come in, they already have an active business that has money coming in. They just need, and they set the entity up on the back end. I have people who come in and say, I literally already been doing this for a while, but I literally wanted to make sure it had enough life before I went into as far as starting a business entity. Pros and cons to that, but I respect it from a conservative, responsible point of view. I want to make sure that I got a proof of concept before I even dig into setting up business banking relationships and applying for business financing and all this other stuff. So if you already have a business that has proof of concept, then that's great. You still want to have the personal financial structure that I'm recommending for you. Why is that? Because there's so many different forms of financing available with you personally guaranteeing or putting up personal collateral. What are some examples? Securities-based lines of credit, one of my favorites. This is going to be, the SBL's basically going to be a scenario where you're the owner of a business, or you're one of the owners of the business, and you have a stock portfolio that is in your personal name and an IRA or a brokerage account of significant enough size that can be used as collateral. One of my favorite forms of financing because it requires literally no credit most of the time. And you can get anywhere from 50 to 90% of a stock portfolio, depending on the lender. And you can get a line of credit so it can be revolving. This is one of my favorite forms of financing that can help you branch into business financing or real estate financing. So this is why you want to have good personal financials and a good track record, because you might just have, a 401k that you rolled over to an IRA when you left an employer that has 50, 60, 70, 80, $100,000 in it that came from a 401k. And so now you have a form of collateral you can use and make yourself lendable at really decent terms, by the way. You can get this with no PG. You can get this, with minimal documentation and really decent terms. You get a line of credit and sometimes, single digit rates, so really appealing terms. Another option we already talked about, inventory. So this is going to be, if you have the type of business that carries significant inventory, this is another form of collateral. So house reseller financing. So this is going to be those of you who are in the business of fixing and flipping or rehabbing properties. If you have $30,000 in some form of liquidity, so some form of cash or cash-like access, then you may be able to qualify to get the financing that you need towards your fix and flipping business. We talked about equipment financing. Book of business. This is unique, but for those of you who just might happen to be in some type of insurance sales or something of the sort where you have a book of business and that book of business is paying some kind of residuals, there's financing for that. I know, crazy, but it exists. And again, this is going to be a scenario where, it might be a line of work. This also could be a scenario where, it could be another part of a business that you have going on, but this is important for you to know it exists. Your 401k can be used for startup financing as well and other retirement assets. This kind of goes back to the securities baseline of credit, but that's going to be more of like literally a separate personal line of, securities portfolio that you have. So stocks and bonds. Your 401k is obviously going to be more likely to be at your active employer. But there are lending options. 401k loans themselves can be pretty darn good. They're really cost effective, as in they're inexpensive. There's no documentation, no credit required if you do a loan against your 401k from the custodian that is, carrying that 401k. This also includes other lenders that will work with you with your 401k to use it for your startup. So that option exists as well. Accounts receivables. So, if you have that, AKA invoicing, we talked about that. The next one's going to be business credit card stacking. I am doing an entirely separate set of live streams and videos around that. I've already done some in the past that did well, but credit card stacking is the most common and one of the most popular forms of funding on the internet. Couple reasons for that. Number one is going to be because it's the lowest barrier to entry possible. Getting qualified for business credit cards is the lowest barrier of entry, where if you just got reasonable personal credit and a decent stated income, you can get your foot in the door. In some relationship banking, you can get your foot in the door with business credit cards relatively straightforward and easy. So that's one reason. The second reason is a lot of people can make money when you do business credit card stacking. A lot of people. It is one of the types of businesses where people can basically broker that process so they can work with other larger entities that are providing the service of business credit card stacking, and they can get paid for the referral or as an affiliate. So a lot of people can come off the streets, get you to, follow them with the business credit card stacking, coming to you as like, the source for it, when in essence, there's a white label behind them that is providing that actual service and, the process, and they get paid. So I'm not knocking this whatsoever. I do business loan brokering and real estate loan brokering as well. So I'm not knocking this process, but I am calling it out a little bit because there's some level of disingenuousness there, where people are going to promote this as this, like, they're going to promote it in ways to make you think it's other forms of funding, or they're going to promote it in ways to make you think it's a lot more attainable than it may be. They're not going to be very transparent about what's going on with it is the problem. So, but it exists. I don't want to get in the weeds on that. I'm going to be shooting a whole nother live stream in the moderately near future just around business credit card stacking again, just to give up-to-date, insight on that process as of 2025. But that is another form of financing that is available that will lead you down the path of PG. Not everything I just named, I hope you've been paying attention, will lead you down a path of no PG. How? Because all of those different forms of financing is something that you either have access to or can easily or more straightforward get yourself access to. If you're smart, you're going to plunge it into your business and get revenue going and get yourself going in a way that will get you the revenues and get your business established in a documented way that will qualify you for no personal guarantees. So what I'm saying is you're going to have to get yourself the trade lines, the credibility, the financial backing, the financial track record, meaning that you're going to have revenues, at least have yourself situated with your banking relationship, if not potentially needing tax returns or financial statements. Everything I just provided you is something that may be in your wheelhouse already to get you that initial funding, since you can't get no PG funding out of it. All right, we cut out a little bit, and then that's going a little crazy, so I'm going to wrap this up in a second. But hopefully you didn't miss out on much of anything. But everything I just named is alternative lending options that might be run under your nose, in an intent to get you the initial cash injection you need to get your first business revenues going. That is what's going to be hopefully get you the funding you need to get the activity you need to get business trade lines going. You want to get business trade lines that are applicable to your business. One of the biggest things that I noticed for people who tried to do the whole business credit stacking thing and trade line stacking thing, they literally had no use for cleaning equipment from Uline or Grainger or tools from Grainger, but they did the process trying to stack the credit. you end up spending money in a black hole, getting stuff you don't need just to try to build credit. So what I'm trying to do is provide you with the alternatives to get that initial cash injection where you can still no PG a lot of these, or if you do have the PG, you just have to be strategic in getting into business activity that generates real revenue. Because once you have cash flow and revenue, as you learned earlier in the live stream, you have many other options to get no PG funding. But to wrap this up and give context, First Tech, yeah, First Tech Credit Cousin is absolutely one of my top lenders that offers the securities-based lines of credit and will do up to $100,000, what is it, $100,000 you say? We say up to $500,000. I didn't even know they went that high. But yeah, they'll do six figures against a line of credit for your securities-based lines of credit. So there's some lenders out there, by the way, that will do that. There are some banks and institutions that will absolutely, once you get to $100,000, $150,000 in stocks or securities or IRA, they will definitely favorite forms of financing. It really is. I really like it. So these different forms of financing will get you what you need to get yourself the revenue and the cash flow, and hopefully the rest of your financial track record if you're smart, to get yourself to the no PG level. But keep in mind the framework we need to close out on. You're looking to build something that is consistent and stable enough with a proven enough track record where banks are comfortable enough to say, I'm literally willing to lean on the business by itself. That's a tall ask for any financial institution that's not specializing in no PG financing. Like I talked about equipment financing, merchant cash advance, invoicing, they're specializing in something totally different. They're literally building their business model around effectively collateralizing other business assets that you have. The higher quality brick and mortar banks and financial institutions are literally looking at the bigger picture because they're going to offer you more attractive financing terms. So they're going to be looking for the entire business operation when they're underwriting you. And so you want to be in a position where you're not going to them desperate, and you're definitely not going to them looking to ask them to take on more risk, and you have nothing to show for them doing so. So I'm giving you a list of alternative options that you may or may not have known were available to get that initial capital, still in some cases without a personal guarantee, and get your business operation off the ground. So just for clarity's sake, no PG versus PG, personal guarantee is going to be more attractive, lower risk for the lender, less expensive, better terms for you, and a broader range of lending options for you. But no PG is going to be the bank or the lender taking on more risk and in reducing your exposure to risk if something goes awry and there's a default process. You can come out of that scenario with limited liability or no liability whatsoever. You're going to end up in a scenario where you have to have some kind of revenues. 50 grand is going to be the baseline that you're going to see for the vast majority of the cases. You're not going to find many of those. You're looking at 100 grand plus in annual revenues before you can start looking at real no PG options. Or you have significant equipment, invoicing, some other form of collateral coming in to get no PG. If you do have a scenario where you're not required to provide credit, or you're able to, or you do provide credit, but they're okay with you having a 450 FICO score, you can be confident that they're going to be expensive, because it is still risky. Even though their business model is based around this form of lending, it is still extremely risky. So I wanted to give a general framework of PG versus no PG, set a better expectation around PG versus no PG, so you can have a better understanding that it is not an entry-level process or program or form of lending. Get you to understand what it looks like through the lender's eyes, what lending options are already out there, some lending options you may not have known were out there, and what you need to be putting yourself in position for, or the thresholds. If you're looking for traditional brick and mortars, you can be confident you're looking at upper 6 figures to 7 figures in revenues for 2 or more years, 3, 4 years, 5 years minimum, before you can walk into the larger mainstream financial institutions. So you want to get yourself in position for that, with that, or for that, by taking the initial capital buying revenue, buy cash flow. You know, your vending machine business, rental properties, something that you're going to do that you're going to get that's going to generate income for you that's relatively predictable, stable, and can be stacked upon. So, wanted to give some context around this. I'm going to be doing more and more live streams around the business funding aspect because that's one of the most proven ways is business ownership to build wealth in this country. And business funding is a crucial part to being a successful business owner and operator. And it's one of the hardest forms of lending to crack into. So I'm going to be spending a lot of time as a business banker providing context. This is JP from Blueprint for Prosperity. I'm checking out to all my pioneers that stuck out with me, Credit Cousin, P&R Connected, and some of my other pioneers that are on the live stream live. A shout out to y'all. If you caught the replay and stuck this out that long, shout out to you for dedicating that much time and attention around your growth and development. Any comments, questions, feedback, thoughts on the live stream as we wrap up and close out down below. Credit Cousin, I appreciate you sticking out and supporting in the chat with your financial content education and giving some additional insights down below. P&R, you a real soldier. I appreciate you always sticking in and dedicating your time and attention to your growth. I can't wait to see what you're doing and what you got going on and how you're advancing. I'm going to be shooting a video for you, P&R Connected, real soon, if you're still on, actually, around that denial you got, I believe, at Chase Bank for not using your credit. So I just wanted to let you know I got a video coming out for you, P&R Connected, probably in the next week or so. So be looking out for that. I might even stick your comment in the thumbnail. You too, cousin. You too, man. Be blessed. Have a great evening. And I'm looking forward to touching base and connecting with you soon. P&R, my guy. All right. So all my pioneers out there, appreciate y'all. Welcome back as always. New viewers, welcome in. You know, the basis of the channel is always providing you with the content that you need to master relationship banking, maximize your borrowing capacity so you can customize your blueprint for prosperity, giving you all of the tools, resources, and strategies necessary to navigate this system legitimately, ethically, and effectively. So comment down below. Comment if you're watching the replay. Make sure y'all leave your thumbs up on the way out. And I want you to also get in the description section if you want to tie in with me on Instagram. Or also, if you want to connect with me one-to-one and work with me one-to-one, there's a link that will be in the description once this gets all uploaded down below. Other than that, I want each and every one of you to stay focused, stay in motion. See y'all soon.